Hi viewers, welcome to the Way to Commerce. We are going to see about that today a very interesting topic, that is basic accounting terms. Because of accounting is a new subject for everyone, and those who are coming to the intermediate, for them also it is new subject. Those who are joining in the degree from other courses, for them also it is a new subject. Okay, so we'll see the important terms, basic terms in the accountancy in this class, and also we are going to see about the principles of accounting. Principles of accounting. See here, we are going to see about the important terms, that is what is accounting, accounting entry, what is asset, what is a debtor, creditor, drawers, and different terms we are going to discuss in this class. Okay, today we are going to see the basic accounting terms. What are the important terms in the accountancy? If you understand these terms, then you will do the easily, you can do the accounting and you can understand the what is accounting actually. Okay, so we'll see the what is account. So account is nothing but it is in the T-shaped proforma. T-shaped proforma. How the alphabet T is there? So it is like this. You can see like this T shape. So here I drawn here small one T shape proforma. T shape proforma. See here it shows left part debit, right part credit. Okay, left part we are calling debit, right part credit. Okay, this is a T shape proforma to record the accounts. To record the accounts or to prepare the accounts, we are using this proforma. Okay. Next, accounting entry. Accounting entry means recording of the transaction. Recording of the transaction. We are calling it as a accounting entry. And next one is business transaction. What is business transaction? Transaction or business transaction, it is an event, it is an action, it is an operation in the business. It may be a buying of the goods, it may be a selling of the goods, it may be a payment of, it may be a receipt, but it must be monetary values. Monetary values. And next, stock. What is a stock? Means goods. Business means we are dealing with the goods and services. So goods is nothing but the stock which we are ready to sell, which we are producing. That is a goods. And proprietor is a person. Proprietor means proprietor is a person or the firm. If this proprietor is the owner of the business. Proprietor is the owner of the business who invest their capital in the business. They are the owner. Assets. Next one is asset. What is asset? Asset means it is a property. It is the properties of the business which creates a benefit to the business. Asset means it is a property and which creates benefit and which creates a useful to the business organization for a longer period to gain the income. And we can see the accounting. Okay, so accounting period. What is the accounting period? Accounting period means it is a time. It is a time. Accounting period means time. For 12 months we are calling is a accounting period. So that only we are calling financial year or accounting period. Okay, business organizations, they will declare their results for quarterly, half yearly and yearly also. So 12 months we are calling is a accounting period. Next, liabilities. Liabilities means that business owes to others. Business owes to others means business has to pay others. It is a liability. Business has to pay to others means it is a liability, like a payment. And we can see the capital. Capital is a term. It is nothing but owner's investment. How much is the owner is investing? How much is the owner is investing? That amount to start a business, we need capital. To start a business, we need capital. Whether it is working capital or fixed capital. So the investment amount which is invested by the owner, it is a capital. And next one, drawings. Drawings means it is a personal use of the owner. Drawings means personal use of the owner. See here, owner sometimes they will draw amount from the business. Owner sometimes they will draw amount from the business for their personal purpose, for their personal uses, that we are calling is a drawings. Okay, and you can see capital here. On capital, business will pay the interest to the owner. On capital, business will pay the interest to the owner. On drawings, owner has to pay. Owner has to pay interest. On drawings, owner has to pay interest. And debtors, you should understand what is a debtor. Debtors means here credit sales. When business is selling goods on credit, when there is no cash, cashless sales. Okay, cashless benefit. Without paying anything, if they are getting benefit, they are the debtors. They need to pay. Means we need to receive. We need to receive money from the some people. Okay, so first we sold the goods on credit. They need to give money to us. So we need to receive. The business need to receive money from them. They are the debtors. Business need to receive money from them. Okay, so they may be a buyers. Okay, so we need to receive. That is nothing but the debtor. The people are the debtors. Next, creditor. Creditor or sundry creditor sometimes. Creditors means here credit purchase. When we purchase, when business is purchasing from the supplier, when business is purchasing raw materials or product, anything from the supplier, here on the credit basis. Okay, creditor also on credit basis. We are not paying the cash. Okay, we are not paying the cash, but we are getting the goods. We are purchasing goods on credit. Immediately we are not paying the cash. So, but in future we need to pay. In future business need to pay. That people are the creditors. Okay. See, creditor and debitor is the opposite words. Then you can see the revenue. What is the revenue? The term revenue means it is the amount which we need to receive. Receivables. Current revenue means current things. Revenue, whether it is revenue income or revenue expenditure, that we need to receive presently. Current year, current month. So that amount receivable is nothing but revenue. Next, expenses. Expenses means the amount spent. That amount spending on the to purchase something or on the charges or making something. So we have to pay. So that is a spend which we are spending on some things in business. That we are calling is the expense. Which we are spending, the amount is nothing but expenditure. Like salaries, wages, that all things are the expenditure only. Income. Income means revenue, expenses. Income is nothing but how you will get the income? Revenue minus expenses. Revenue means received. And we are paying something. So received minus paid. For example, received 10,000, paid 5,000. 10,000 minus 5,000. Remaining 5,000 is the income. Next one is a voucher. So in business transactions, vouchers we are preparing. Why we are preparing the vouchers means it is a proof for the transaction. Voucher is a proof or evidence to the transaction. Okay, whether it is buying or selling, voucher is a proof to the transaction. And next one is the term receipt. Receipt is nothing but it is an acknowledgement. Receipt is an acknowledgement for the transaction. Okay, it is acknowledgement. We can say it is also proof. Receipt. Next we are going to see about the brought down. Brought down means Opening balance. So when we are starting the ledger account, we will start with the opening balance that we are calling is a brought down. Just we are showing the B by D. Brought down means B by D. That we are saying it is a opening balance. Opening balance. Ledger opening balance. We are calling it is a brought down. Okay. Brought down. Then what is a carried down? See the term carried down, C by D. It indicates C by D. C by D means when we are closing the ledger, ending of the ledger, closing or ending of the ledger with the C by D. So whatever the answer we are getting in the ledger account, so that is nothing but C by D, carried down. C by D we are showing it is a carried down ledger account ending part we are showing. Okay. Next, equity. Equity means it is nothing but the claims. Equity is nothing but the claims against the shares, whether it is equity shares or debentures. So here equity means owner's equity. It may be a owner's equity. Okay. It may be a creditor's equity. Okay. Owner's equity means shareholder's equity. Creditor's equity means debenture holders equity. Okay. Debenture holders are the outsiders. Here you can see the equity is nothing but the claims. And next one, journal. What is a journal? Journal is nothing but the original entry and it is a first entry. Journal is nothing but the original entry or the first entry for the transaction. Okay. First writing the transaction. The transaction we are writing in the journal entry based on the debit credit rules. Next one, posting. What is a posting? Entry from the journal. See, posting is nothing but the journal entries writing. After writing the journal entries, we have to post the journal entries into the ledger. Posting means journal to ledger. Journal to ledger we are transferring. Okay, that is nothing but the posting. And what is a debit and credit? The term debit and credit we are showing with the DR CR. Debit means DR, credit means CR that we are showing for the account. So for an account, debit part, left part we are showing as a debit. For account, left part we are showing as a debit. And right part we are showing as a credit. Left part debit, right part credit. Okay, that is the rule. Hello viewers, welcome to Way to Commerce. Today we are going to learn the very important and easy method. We are going to see about the accounting principles. Accounting principles which contains the concepts and conventions. Concepts and conventions. Accounting principles. Accounting principles includes the accounting concepts and accounting conventions. So we are going to see the what is accounting concepts. Accounting concepts means basic assumptions. Basic assumptions and it is a condition. Necessary condition means by following these accounting concepts we are going to do the accounting. Okay, according to the concepts we have to do the accounting. Okay, see these accounting concepts are different types. First one, business entity concept. First one, business entity concept. Business entity concept means it separates the owner from the business. So it divides the owner is separate and the business is separate. Whatever the accounting transaction you are writing in the books of accounts, you have to write business point of view, not owner's point of view. Okay, so when the owner is investing his capital in the business, when he is contributing the capital in the business, he is a creditor. Owner becomes a creditor. When he is taking the drawings for personal use, when he take the money from the business, it is a personal use. We are calling drawings. In that case, he is a debtor. Owner is a debtor. So two situations is there. One time in capital case, owner is a creditor. In drawings case, owner is a debtor. Okay. And next, second one, we are going to see the dual aspect concept. Second one, dual aspect concept. Dual aspect concept means it is a double entry system. You can see here the double entry system means which contains the debit and credit. Debit and credit. Okay. So one transaction we have to record two aspects. One is debit aspect, second one is credit aspect. Means receiving aspect and giving aspect. Receiving and giving. Receiving is equals to giving. So according to that we have to do. So accounts we have to do according to the dual aspect concept, double entry system. And next one, going concern concept. Third concept is going concern concept. Going concern concept means business will continue for a longer period. Business will continue for a longer period. Based on this business entity, going concern concept, these we can see the assets are the fixed assets is there. Fixed assets why we are purchasing means for a long period, for a usage of the long period, for the benefit of the long period. Okay, so business will continue for a long period and we will earn the profit. Okay, next, money measurement concept. Money measurement concept means business transaction recorded in monetary values. Okay, for example, salary means money only. We are calculating in monetary, measuring in monetary. Rent money, insurance money, purchases money, sales money. So which we can measure in monetary values only, we should treat as a accounting transaction. If non-monetary means we are not going to enter in the books. Next one, cost concept. Cost concept means here the purchase cost of the asset we are recording. We are recording the purchase cost. Starting how much it is we purchased. Because of if you see the asset value in the market will change. Market value will change. But here purchase cost will not change. So we have to treat the when we are calculating the accounts. So material or the cost of the asset we should see, not the market value of the asset. Okay. Next one, accounting period. Accounting period means here accounting period for 12 months we are calculating. Accounting period means accounts we are doing for 12 months. It may be two types. 1st April to 31st March. 1st April to 31st March, that we are calling it is a financial year. Okay. Second one here you can see the 1st January to 31st December. 1st January to 31st December. It contains the 12 months value. 12 months. You can see here it is a calendar year. Okay. So 12 months means accounting period. Next one, accrual concept. Accrual concept means matching concept. In this matching concept, it matches the incomes and expenses. Incomes and expenses of the current year. How much incomes we are earning and it matches to the expenses, like receipts and payments. So it matches the incomes and expenses. And we can see in this concept, for example, if we sold a machine for rupees 42,000, its cost previously we purchased for 30,000. So to generate the 42,000 incomes from the sales, we are spending 30,000 cost. Okay, so cost must be equal to the income. Cost must be equal to the income, means we are matching the incomes and expenses. Okay, to get this benefit, how much we are spending. Okay, from this we are getting benefit or not. So matching concept it is. Next one, realization concept. Realization concept means revenue. It relates to the revenue. Revenue means the current year income. In this revenue which is realized, or we are going to receive. We may not receive in cash present, but we are going to compulsory receive. So that is nothing but the realization concept, realization of the revenue. Next, we are going to see the accounting conventions. Accounting conventions. First convention is convention of disclosure. Convention of disclosure says about the full information. Full information to the needed parties. Full information to the needed parties. For example, debtors, creditors, or the employees, customers, government, all the parties they need information. So this discloses, accounting convention says accounting information, full information, not some information, full information they are giving to the parties. Next one, convention of materiality. Convention of materiality means only the significant information which is useful for the making the decision. Okay, which is useful for the take a decision, that we are going to see in this materiality. Materiality means the significant information, needed important information only, not full information. And here convention of consistency. You can see the convention of consistency means in business for some years we have to use a standard accounting method, a particular accounting method. For example, if you are using a fixed method, for example, depreciation, if you are using fixed installment method, means you have to use the same method for a number of years. Okay, then you will get the accurate result. Then you can understand. Okay, you can get the accurate result and you can understand if you are using the fixed method. Okay, next we are going to see the convention of conservatism. Convention of conservatism. It says about the losses we have to record compulsory. Okay, sometimes we can ignore the profit, but losses we have to record compulsory. Why we have to record the losses means to know why we are getting this loss in the business, to know the reasons for the loss, to know the reasons for the loss, we have to record the losses compulsory. These are the four conventions. Convention of disclosure, convention of materiality, convention of consistency, convention of conservatism. Okay, thank you for watching, and please subscribe and like the videos and share for the benefit of the students.